Hello, income growers and harvesters. Hope you're all having a great day. This is the Harvesting Income channel where you learn how to make your income and grow your income. Okay, CDAY is the first Canadian zero-DT ETF, which was launched recently. This was launched in the July 2025 recently, and the name of the fund is Hamilton Enhanced Canadian Equity DayMax ETF. The good or the interesting part of the fund is the semi-monthly distributions. The fund is able to distribute dividends, twice a month, and they write court calls on an everyday basis. And this is kind of similar to all these Roundhill, XTTE, RTTE, those kind of funds. And we have to now dig deeper to see what kind of investments they make, what is the underlying assets, what is the strategy. So there's a lot of information to unpack here. Okay, before we go there, a quick disclaimer, this is not financial advice. This is just for, education and entertainment purposes only. Okay, Hamilton Enhanced Canadian Equity DayMax ETF. So what is the strategy like? It is two-pronged. One is primary investment is into CMVP, which is also a Hamilton fund. And CMVP stands for the Canadian Dividend Payment Companies, ETF. So that's one part of the investments. They're investing in dividend paying companies and companies where the dividend is expected to grow in the future. Dividend growth investing strategy. So that's a simple way to put it. The second part is they generate premium income by doing the zero DTE covered calls on Canadian equities. So the second part is the interesting one, the zero DTE part. Plus they are combining that with the dividend growth investing strategy. So this is slightly different from the American counterparts where the American funds are more focused on just the zero DTE part. But this one is combining zero DTE plus a bit of dividend growth investing as part of the package. Now, how good or bad it is, time will tell. Like the fund has a limited history, but let's look at the basic features of the fund or the basic metrics. The ticker symbol is CDAY. The price is about 25.71 cents, um, and the fund was launched July 2025. We are now in October, so basically it's about um, August, September, October, 3 months. A limited history, and net assets about 139 million. Management fee of 85 basis points. And so this is from the Hamilton ETFs. I would say that the fee and a few other, you know, data points look attractive to start with because it's a relatively new fund, new concept in Canada. However, in future we may see that the management fee could pick up to probably 1% or slightly higher because of the expenses, trading expenses, and so on. But as of now, these numbers look decent. Now let's look at the portfolio. What do they actually invest in? There are two parts of the portfolio, like I said in the beginning. One is the dividend growth investing part, and the second would be the zero DTE covered calls. So let's first look at the growth investing part. The growth investing part is the CMVP portfolio, which you see on the right. Like you can see the list of companies here, CMVP portfolio, and you can see like I have listed down the top 20 stocks, and all these are Canadian names because it's a Canadian fund. So Agnico Eagle Mines, Franco Nevada, Wheaton Precious Metals, Enbridge, Emor, RBC, Fortis, all the big blue chip names that we are familiar with. You also have the Canadian Natural Resources, Manulife, BC, Sun Life. So it's a mix of mining companies, energy companies, financials, and also a bit of life insurance and all these retail biggies like the Elimination Coast Guard, and they also have the oil and gas, Canadian natural resources. I see that this is pretty much diversified, but of course it's more focused on those resource and financial and communication sectors, which is typical for any Canadian fund. So I don't see any surprises here. Good selection, but good diversification too. Not super interesting. It's just a very standard, dividend growth fund. Stock selection is pretty good. All big blue chip names. Now let's move to the CDAY part of the portfolio. So in this one, they are going to use the S&P 500 and this one combined. Plus, they're going to write, zero DT options on the TSX. So that combination is going to give you a higher amount of premium income. Plus, you got the dividend growth strategy combined with that. I mean, the dividend growth strategy is going to give you more stability because you're going to get a steady stream of dividends. Plus, since you have these blue chips as part of the portfolio, it's going to give you not only the dividend growth and dividend flows, but also, you know, steady capital appreciation. Not dramatic, but more like a steady or moderate capital appreciation. And that could actually do well in the long term. So that's the positive side that I see in this fund. And they have tried to customize this strategy to the needs of the Canadian market. And that is something, understandable because we don't have the same kind of design as we see in the US markets. So it's a good move by the Hamilton ETFs to launch this as the first mover. Okay, this is the part that everybody is waiting for. I put it all in one slide so that I can, give you the whole picture rather than trying to, divide it into price, dividend, and total returns. When I look at the price, like it's a short history, there's still not much to talk about. But within the last 3 months, the fund has, given about 5.4% price returns. But of course, this is not to be seen in isolation, but I'm just breaking it down so that you can understand the parts. So price return of around 5% in the last 3 months, pretty decent. But 3 months is a very short term, like to judge any fund. Okay, so let's be fair on that. And from that point of view, yeah, price appreciation is good. And when you look at the dividends, like we don't have much history. Like there are about six semi-monthly dividends. So semi-monthly means like twice a month. Like they pay once in the middle of the month, once at the end of the month. So in a full year, since they pay twice a month, you will see 24 dividend payments the whole year, roughly. So in the last six semi-monthly, periods, which means the last 3 months, they paid about $1.08. So I've done the math. Like roughly, they paid 18 cents every, you know, semi-month. So in a month, they were paying around 36 cents monthly. So when I do this for 3 months, it comes to about $1.08. So based on that, if I do the annual calculation, but this is all speculative. I mean, we don't know how the fund will perform for in the first 1 year. But let's say if the fund is able to perform the same way, uh, roughly my estimate is they will be able to touch $4.71 in 26 semi-monthly periods. So this number could be wrong. This is just a speculation or estimate. So in that, from that point of view, if I look at the July 15 price, imagine I invested in July 15, so I would be seeing somewhere around 19%, 18% yield. Even if I look at the current price, the yield will be more or less around 18%. So give or take, uh, you know, plus or minus 2% from here. So you could look at something in the 15 to 20% range is what I am expecting, but we don't know. And this is not investment advice. So, we never know how the performance will be, and also the markets can move up and down. So, but looks like they are going to give some returns in the high teens, uh, and that is pretty attractive for income investors. And especially when that payment is coming twice a month, that's pretty good. Okay, those were the features of the fund and the dividends, the total returns. Total returns are decent. If you look at the yearly returns, like around 18% seems to be decent for the fund. Uh, the first pro is high distributions, which is obvious. The second is the distributions are paid frequently, twice a month, and that helps people to reinvest the cash. But that should not be the sole aim of your investment. That should not be the goal here. If you're looking for other dividend growth options. You can look at other funds, but this is a good option because not only are you getting good distributions, but you're getting blue chip companies at a good, um, you know, within a fund, and you are getting that dividend growth option and potential with the capital appreciation. So the price appreciation wise also it is pretty good, and the underlying portfolio of blue chip stocks will help, especially in turbulent markets and when there is a turn in the economic cycle. Right now, the economic cycle is positive and things are going in the right direction, but at some point, if there's a bubble, probably an AI bubble or some other economic issue or slowdown in the economy, anything can happen, right? So if that happens, then you've got all these blue chip companies, all these blue chip names, so you're not going to lose sleep over it. So that gives you a peace of mind. So those are the pros or positives of the fund. Now let's look at the other side. Like the fund has a very limited history. So even though we have these positives, you got to take it with a grain of salt because you've got a very limited history of 3 months. So in next 6 months, next 1 year, anything can happen. And the zero DTE strategy is fairly new in Canada. So again, lack of history is another problem. But I don't think that's a main major issue because Hamilton funds have a good amount of experience with covered calls and other types of option strategies. And they have a great team. So that should help mitigate the problem of, the new strategy. So that should help mitigate this. So overall, the fund has all the positives, all the right ingredients to, become the not only the first but also the successful zero DT fund in Canada. But time will tell. We never know. So let's move to the next area. What are the other options if you look into the Canadian market right now? We have only two other options, and these two are all part of the same Hamilton ETF. And by the way, I'm not recommending this particular fund house, or this is not sponsored by Hamilton or any fund. This is just my own listing. So far, we have three funds. CDAY is what we are covering in this, presentation. But SDAY, which is the US equity DayMax, which covers more or less like the blue chip S&P 500 companies. Not all the 500 in the index, but selection of S&P 500 companies and which pay dividends. And also they use the zero DT covered call strategy on that. So SDAY is based on that. And QDAY is obviously based on the NASDAQ, the tech companies, picked up from the NASDAQ 100 index. So these are funds which have a selection of dividend paying stocks. The QDAY would be more of a growth oriented, whereas SDAY and CDAY are more, dividend growth oriented funds. So if you're looking for a tech exposure or a high growth sector, then QDAY, which is the Hamilton Enhanced Technology ETF, is a great option. But if you're looking for a more broad, diversified fund, then SDAY, which is more broadly diversified into the S&P 500, would be a better pick. So those are the alternative picks that I have for you, and we have also covered the pros and cons. And this is the first ETF with a limited history. So let us keep a track on this and keep watching this and see how this performs. And in future, I will keep a track of this. And if you have any comments or feedback, please drop them below. And if you liked what you're watching so far, please feel free to subscribe to this channel and also hit the bell button for any updates. Thanks a lot for watching. Have a great day.